Hello, welcome back to Jones Lang LaSalle's third quarter market update for Southeast Asia. This quarter, the focus is on the Philippines, which has outperformed most other Southeast Asian markets. Unlike other Southeast Asian economies, which saw a cut in their economic forecast, the Philippines economy continued to grow on the back of the business process outsourcing sector. GDP growth for the Philippines is expected to close at 7% for 2013, up from 6.1% previously, compared to Indonesia, which has revised their forecast downward to 5.6% from the earlier 6.6%, while Thailand also dropped its outlook to 4% from the 5.4% previously. Now, nonetheless, the economic fundamentals across Southeast Asian economies remain stable, supporting the real estate performance. Now, for example, strong demand from business process outsourcing firms, IT, financial and banking sectors pushed Manila office rents up by 1%, while strong investor interest drove yields lower as capital value growth outpaced that of rents at 2%. Although the large volume of supply is expected to raise vacancy rates by 2014, the further entry of offshoring and outsourcing firms is expected to support a healthy take-up, keeping rents steady over that period. Bangkok also saw rents expanding at 2% on a US dollar basis, driven by relocation demand in a limited stock environment. Similarly, yields expanded marginally on the back of strong interest but limited assets for sale. By end 2013, positive investment settlements with limited office space supply is expected to lift both the rents and capital values of the office sector further. The Jakarta office market continued to lead a group of over 4% increase in rents on a US dollar basis this quarter. Demand remains driven by business services, mining, banks, and financial institutions. There was no new supply of office buildings this quarter compared to last quarter. As a result, vacancy rate fell to 3.8% from 4.7%, but overall capital values rose 3.9% on the back of strong interest by international investors. The Singapore office market continued on a modest growth as global uncertainty continues to dampen occupier confidence. Overall, demand has been driven largely by small occupiers, with rents rising at 2.7%, while underlying strong market interest kept capital values stable in local currency terms, or a slight increase of 1% in US dollar basis, resulting in yield expansion. Now, looking ahead, the office market is likely to see modest growth as cost savings still form the key factor in companies' decision to expand. As for the residential sector, demand in Bangkok remains strong, resulting in rents growing marginally at 0.2%, while investor demand drove capital values higher at 0.3%. The influx of expats from MNCs and the offshoring and outsourcing sector has supported leasing activity in Manila, resulting in rents growing 0.6% in US dollar terms. Capital values likewise expanded faster at 0.8%, supported by greater investor confidence in the domestic economy. Jakarta residential market, on the other hand, saw rents softening marginally at 0.3% in US dollar terms. The impact of the economic slowdown and tighter competition from new supply has resulted in landlords trying to keep rents steady. Investments, however, saw continued interest from foreign institutional players, while local cash-rich investors helped keep capital values steady. On the Singapore front, the new financial regime has taken a toll on the high-end market as rents and capital values dipped marginally on local currency terms. As the Singapore dollar strengthened against the greenback, overall in US dollar terms, both rands and capital values increased slightly. Overall, we reckon the prime market is likely to underperform until we see a more pronounced recovery in the global market. On the retail end, strong domestic demand and rising tourism were key in driving leasing activity in Bangkok. Fashion and accessories and F&B sectors were the key drivers this quarter, with new international brands targeting prime retail centers such as Siam Paragon, Siam Centre, and Central World. Rents rose 0.5% on the back of tight supply, while capital values rose alongside at 0.6%, keeping yields steady. Similarly, strong domestic demand continues to support retail leasing in both Manila and Jakarta. Retail rents in Manila rose 0.5% as foreign brands continue to make their foray into the Manila market. Capital values increased slightly, keeping yield unchanged. Jakarta retails, on the other hand, registered stronger growth at 2.4%, while capital values kept pace, resulting in stable yields. However, the weaker rupiah resulted in a lowering of rents and capital values at over 12% on a US dollar basis. Finally, in Singapore, the retail market saw rents rising modestly, capped by the limited supply in the prime market. Capital values rose 2.8%, supported by IPO activity in the REITs market. Looking ahead, we remain positive on the outlook of the office and retail markets in Manila, Jakarta, and Bangkok in the short term. And in Singapore, we remain equally positive for the office and residential markets, given the potential upside over the recovery cycle in the mid to longer term.